Welcome back to Investing Talk Podcast. Today we're taking a closer look at Skechers. We got a bunch of recent reports and analyses you shared wanting a clear picture of what's going on with the company. And, well, that's what we're here for. Our mission is to pull out the key bits from these sources, give you the essentials on their recent performance, this big news about a potential acquisition, and what it all might mean going forward.
Okay, let's get into it. We've got info covering their latest financials, the acquisition announcement itself, and, some of the broader context around how they operate and the industry they're in. Seems like there's been quite a bit happening lately.
Definitely. So let's start with how the company's actually been performing. First quarter of 2025, on the surface, looks pretty solid, right?
Yeah. They reported record first quarter sales, $2.41 billion. That's up 7.1% compared to the same time last year.
Okay, 7.1%. And I saw something about constant currency, too.
Right. If you sort of strip out the effects of currency exchange rates changing, it's actually a little higher, comes in at $2.46 billion. And looking back, their total revenue hit around $8 billion in 2024. They were projecting something like $8.4 billion for this coming year.
Yeah, but here's the interesting part, isn't it? Despite that revenue growth, they did something a bit unexpected with their forecast.
That's right. Even though the earnings per share for the quarter beat estimates by a good 15%, Skechers actually withdrew its full-year guidance, pulled it completely.
Which does make you stop and think, why would a company with sales looking, well, pretty healthy, pull back on telling the market what they expect for the rest of the year?
That's the key question here, and the sources are quite direct about the reason they gave. It's global trade policy uncertainty. One report even called it global trade policy chaos.
Okay. So it sounds like external stuff, maybe tariffs?
Almost certainly. Tariffs on materials they import, it just creates too much instability, apparently, for them to feel confident forecasting their performance accurately. Imagine trying to set prices when the cost of what goes into your shoes could change dramatically because of trade policy shifts.
Yeah, that makes sense. Those tariff talks have been ongoing. But now, the really, really big news that kind of overshadows even those sales figures is this potential acquisition.
On May 4th, the announcement came out. Skechers agreed to be acquired. The buyer is a private equity firm, 3G Capital, and the price is $63 per share.
$63. Now, how does that compare to where the stock had been trading? Sounds like a jump.
Oh, it's a significant jump. Represents a full 30% premium over Skechers' recent stock price before the news.
30%. Wow. Okay, so the market must have reacted pretty strongly then.
Instantly. Dramatically. The stock price shot up 25% in a single day's trading on May 5th, which is quite a turnaround considering the stock had been down, about 30% just this year up to that point.
So a huge shift in investor sentiment, almost overnight. What about the deal itself? Is it done? What's the plan?
Well, it's pending regulatory approvals, as these things always are. But what's interesting is the current expectation. They expect the existing Skechers management team to actually stay in place.
Oh, okay.
Yeah, with the focus supposedly remaining on, product innovation and growing globally, it suggests 3G Capital sees value not just in the assets, but in the current leadership and their direction.
That premium, that 30%, it does signal that 3G must see some serious potential there, right? Maybe something the market wasn't fully appreciating.
Could be. Perhaps they see opportunities for efficiency, or maybe they think they can really accelerate that international growth or the direct-to-consumer side of things. It definitely points towards a strategic vision beyond just a financial play.
Okay, let's zoom out a bit. Skechers is playing in a huge sandbox, this athletic and leisure footwear market. Over $100 billion, you said?
It's massive, yeah, and very competitive.
So what's their angle? How do they compete against the giants?
Well, their advantage seems to be built on a few things. They've got a strong brand name, especially associated with comfort. They offer a pretty wide range of products. Walking shoes, like their Duo Walk line, are huge, but also performance stuff, work shoes. And they've apparently got a cost-effective supply chain, which is absolutely crucial in footwear.
Right, focusing on that comfort niche across different categories. And they do collaborations, too, trying to reach different types of customers. But they're not immune to industry pressures, clearly. That trade policy chaos is proof of that.
Exactly. The tariff impact is a major headache, and it ties right back to pulling that guidance. But, thinking about industry trends, the acquisition could actually tie into another big shift, the move towards direct-to-consumer, or DTC.
Selling directly to customers online or through their own stores.
Precisely.
Yeah.
Skechers mentioned focusing on DTC in their recent earnings call. Maybe this acquisition gives them the capital or the push to really double down on that, gain more control over sales and customer relationships, maybe buffer some of that tariff impact.
Interesting angle. So before this whole acquisition thing blew up, let's quickly recap strengths and weaknesses.
Strengths were definitely that strong brand and comfort, the diverse product range. Weaknesses, or maybe red flags, were clearly the high exposure to those tariff risks. And, well, investor confidence definitely took a hit when they pulled the guidance. Plus, the stock had been underperforming the wider market.
Okay, so now how does the acquisition potentially change things? What's the impact?
Well, it could be a major catalyst, right? 3G Capital could inject capital for growth, maybe help restructure operations for more efficiency. And 3G has experience managing big brands, so maybe they can help accelerate that international growth even faster. Remember, about half of Skechers sales are international.
But it's not all smooth sailing, I imagine. There must be risks still.
Always. For one, the stock will be delisted eventually if the deal goes through. That means less liquidity for anyone holding shares who doesn't sell. There's always the chance of regulatory roadblocks, delays, or the deal could even fall apart, though the premium suggests both sides are serious. And fundamentally, the reason for the uncertainty, those trade policies and potential margin pressure, that doesn't just disappear because the company has a new owner.
Good point. How are the analysts viewing Skechers before all this acquisition news broke? And where do they sort of fit against the really big names like Nike or Adidas?
Before the news, sentiment was, let's say, cautious. EPS estimates were actually being cut by analysts.
Yeah.
In terms of market share, Skechers is kind of in that mid-tier. They're big, but not Nike or Adidas big. Their strategy is different, too. More focus on affordability, comfort niches, versus Nike's tech focus or Adidas's more premium branding.
Okay, so let's try and boil this down. For you, our listener, what are the really key takeaways here?
Okay, first, Skechers showed some underlying business strength with those recent strong sales numbers. That's important context. Second, this acquisition offer, especially at that big premium, signals that 3G Capital sees significant untapped value or potential in the company. Third, the whole reason for pulling guidance, that trade policy uncertainty, really highlights just how volatile the global economic climate is for businesses right now. And finally, for shareholders, the deal offers a clear exit price. For everyone else watching, it suggests Skechers could be heading in a new direction under this private ownership.
So putting it all together, it looks like Skechers, while definitely facing some real headwinds from global trade stuff, has caught the eye of a major investor. This could signal a whole new chapter. Maybe the acquisition helps them navigate that market volatility better, gives them a stronger platform to grow from, which brings up a really interesting question for you to think about. How do these big private equity buyouts tend to play out in the long run for companies like this? And what might it mean for the wider footwear industry? We hope this look at the situation around Skechers has given you a clearer picture. Please do subscribe, like, and comment. Let us know what other companies or topics you'd like us to tackle next time.